Perfect. Thanks, Steve. Hopefully everybody can hear me. Yes, I think the last panel before the drinks, and I think some of the panelists said no drinks unless there are questions. So hopefully you guys are going to be active participation here. Brief introduction on the panel here, maybe starting here on the left of Florian Steiger from the new fund Icosa Investments. That you're here. Tanja Wrosch from 12 Capital, heading up the cat bond portfolio there. Michael Bennett from the World Bank, and then last but not least, Colin Scagell from Mayer Brown. Yeah, I think as Steve mentioned, I think we want to cover in the next hour the cat bond market outlook, the state of the market, and really I think we have a good representation here, really from some of the investors. Michael representing the sponsor view. Here and then Colin really also from a legal perspective, and maybe I can add a few comments as well from a more structuring type perspective. Again, feel free to kind of jump in with questions. I think we're going to leave some time at the end as well, but if there's anything before then, feel free to kind of raise your hand, and hopefully we can make this a little bit of an interactive discussion. I think the plan is really to talk about the state of the market, kind of a little bit of a recap on what people have seen earlier this year. But then really go through a little bit the challenges, the investor sentiment, talk about topics like secondary liquidity and others, and again, hopefully make this an interesting discussion. Starting off maybe with the state of the market, and maybe Michael from a sponsor perspective maybe first, or I think talking a little bit about, 2024 obviously has been a pretty active year, 13 billion issued to date, or I think seems to be we're on track for kind of a record year, given that 2023 had 16 billion and it's only September, so I think good outlook. But yeah, maybe you can talk a little bit from your perspective about what you have seen from a sponsor side and initial thoughts about 2024.
Yeah, thanks, and great to be here with everybody. At the World Bank, I guess we're a very unique sponsor in this market in the sense that we bring very different risks to the market. I think we're probably the only sponsor like that. We'll bring, Philippine hurricane and Chilean earthquake and pandemic. So we're really seeing the market and investor interest, investor capacity from many different perspectives. And this year was unusually busy. Big first half of the year for us. We had our busiest month ever. We did 5 tranches of Mexico risk and 1 of Jamaica hurricane risk, all within the same month. It was a record month for us. And we, as I've been saying a lot lately and occasionally to the press, we really value predictable capacity. We clearly would like to get very attractive pricing as well, and we try as hard as we can to get very efficient and attractive pricing. But to some extent, we accept that the market pricing moves in ways that are not necessarily connected to our own deals. That a bad Florida hurricane season will hurt us pricing-wise, and largely, I would say, our underlying clients, which are sovereigns, accept that pricing will go up and down. And I think you've seen our clients come back to the market who might have done a deal when pricing was at a much lower level, and they're willing to come back. So to some extent, we accept the pricing dynamics of the market the way they are. It's really capacity where we have, I would say, the biggest concerns, because when we bring a client to the market, what's behind that is political processes, is sometimes parliamentary processes. It's a tremendous amount of work being done by the governments, first of all, just to decide to do an ILS transaction and then decide what transaction to do. And the nightmare scenario for us is a lack of capacity. And I guess we've found it not terribly predictable, the capacity, because obviously Steve is our basic source of information. And we sometimes are reading from Steve that the market is great, money's pouring in, and suddenly, our deals, we expect it's going to be a blowout, and we're sweating it out as the book builds. And other times Steve is saying, it's not so good, and we have a big book. So, and of course we're not doing this work ourselves. We're working with the big lead manager firms, and we think they're giving us information about, good information about the market. I'm sure they are. But it's been very unpredictable, I would say, and I think that's been true the last few years. I mean, to give you an example of what I mean by unpredictable, we brought a repeat deal to the market this year that had just been done 2.5 years before. We brought it back under the same model. The model hadn't been changed at all in the meantime. We brought it back at a much higher price, reflecting the price difference from 2.5 years ago. And our largest order in the deal 2.5 years ago came in at 0 this time. And when I asked them, why did you go from being our largest single order to not wanting it all, they said, this isn't consistent with our view of risk, which is exactly the same risk we offered at a much lower price 2.5 years ago. That kind of surprise makes it very, very difficult for us. What we are, my hope and what I'll ask, Santa Claus for this Christmas is, even more money in the sector, bigger diversity of investors. I got to admit, when Steve writes about a merger of ILS firms, it gives me a little bit of heartburn, because we don't have that, we don't have that many big ones in our book, and if 2 big ones merge, it could be incredibly positive, or it could be incredibly negative. But it's really, a barbell scenario. It's on one side or the other for us. That would, I would say it's great that the market's growing, but we need, for us to be comfortable bringing these big chunky risks to your market, we need even more capacity coming in so that we can be sure. Again, we'll pay the price we have to pay, but we need to be sure the capacity's there.
And then Michael and present company excluded, hopefully, around the merger comments. But just on kind of drilling a little bit deeper on this, I mean, I think obviously you've done a number of deals this year. Obviously, you have done deals kind of most years. Have you noticed any specific times where there was a bigger issue than a less of an issue, or is it really there's just an
oh no, it's changed dramatically. I don't know if people remember. The deal we did was called a Pacific Alliance cat bond. We did 4 countries issuing cat bonds simultaneously the same day. We had an order book over $2 billion order book. At that time, the market was much smaller. There was much less AUM in the market. Enormous order book. Market's doubled since then, perhaps. AUM probably at least doubled in terms of what I see publicly listed for the big firms. I can't imagine a $1 billion order book for that today. So it's definitely dynamics change, and maybe the other thing we see is interest in parametrics swing largely even at the same firms. We have some investors tell us. It's great parametric, no trap capital. We don't have to worry about inflation. It's clean. We love parametric. And then we go back and they say, no, we don't really have much interest in that. So there's definitely a consistency and probability issue for a sponsor like us in the market, and love to hear from you in the investor side.
The other side. Okay.
The investor side, if we're just doing something wrong, or if there's an obvious solution to this.
You need for more communication, but I don't know, Tanja, you want to start?
Shame on us. Yeah, I mean, I totally hear you, and Santa's wish is noted. No, I mean, we're big fans of your issuances, definitely. I think it comes a bit, it's a two-edged thing. We have our own view of risks. These change, these evolve, especially when you merge. But also, in a sense, we're also intermediaries for the end client. So it's also very hard for us to estimate the capacity. I think one example is the great performance that we had in the funds. We all know cat bonds have been doing great. So you would think, wow, we have inflows. Everybody kind of is interested. We love it. We can plan with even more capacity next year. But you have certain investors that take their gains and they actually redeem. So you're really surprised by that. And sometimes they have not the best timing in terms of the market, and then it leads to these unpleasant situations. I think it's just the result of dynamics. It's nobody's fault, I would say. But yeah, definitely understand and note it. And for us, I mean, coming back to your first question, it has been a great year so far. The issuance volume was great. The number of issuances is also great. The volume, especially for a big manager like us, is important. That the tranches are big. And what I also really liked is it was kind of late up until really the start, or even in the beginning of the hurricane season, you could still deploy capital, so that has helped very much, and we hope that this continues and that we see hopefully very early deals coming now in autumn. That would be quite beneficial, hoping for that.
Florian, do you want to?
Yeah, I share your frustration, Mike, to be honest, because especially this year we came from a situation where we had way too much liquidity in January, so you could sell anything in the secondary market, just mark up a fantasy price, and you could sell it. Then we had the big correction in the second quarter. There was by far not enough liquidity in the market, but everybody wanted to come to the market. And now we are back again. If you want to buy any cat bond in the secondary market right now, good luck. Nobody is selling anything. And in a way, we are, I would say, recipients of the same problem, just on the other side. And a lot of that could probably be overcome by better information from the brokers when which deal will be coming. Also, I don't understand, for example, why earthquake deals, why do they need to be brought to the market in spring? You could as well do them in August or September, for example, when historically we've often seen the situation that you cannot deploy capital in the market. So I think that's really, I would say, it's a wish, but it's also homework for all of us in the industry to be a bit more, I would say, clear about timelines and when what will be coming to the market. Because for us, I'm always stressed. First, I need to raise the money, then I need to deploy the money, then I'm stressed about not losing it in the hurricane season, and then about keeping the clients happy. And if somehow we can kind of break that circle a little bit, it would greatly benefit the industry.
Well, it's a constant level, so that's good. But
keeps me on my toes. Yeah.
I think maybe one or kind of two other points to mention. Also, one, I agree. I mean, communication obviously between all parties should help that, even when there's a certain level of unpredictability, or because obviously inflows can only be predicted to a point. Or I think the other element, which is kind of important, and maybe Michael, that's a little bit. I mean, is the timeline lag you have from making a decision to do a deal to actually bringing a deal. And I think that's, and then I think to your point, or I think what we're seeing quite often is that in times where investors want to see a lot of deals, I think the pricing also kind of reflects that to some degree, that it's attractive. And I think generally sponsors certainly would like to bring a lot of deals, but it takes 2-3 months to actually put them together. And when more than 1 or 2 or 3 sponsors have the same idea, you suddenly get that flurry of deals, which you then often arrives at a point in time where a lot of capital is already deployed, and then it kind of swings up, swings kind of back and forth. So I think that's a lot of the challenges. I think the market still hasn't fully resolved, and I think certainly the communication and clear communication about pipeline is crucial, but that's just another,
maybe as an idea, and I floated it today in a meeting, why not have cat bonds with longer maturities? Yeah. So we need to renew a third of the market every year. That's 14 billion every year. And if there's a little accident, let's say some hurricane, something happening, the market is on hold for 3 months. So that's missing. Then it needs to be made back up later on. Why not have 4 or 5 year deals? Especially if it's for risks where the risk is not changing that much. Parametric earthquake is a great example that shouldn't change that much over 4 or 5 years, the view of risk.
Yeah, and I think, that's an interesting point, and Michael, from your perspective, longer term deals, I think from a sponsor side, certainly sometimes can be helpful, or obviously sometimes things change over 5 years from a protection need perspective, but
I mean, I think definitely in theory a longer deal could be very attractive because it takes a lot of effort for a renewal to happen. I think at some point the headline premium cost could become too much for a government to be interested. In other words, if we showed 5 years of premiums on day one
3,
versus the coverage amount, it may look, not terribly appealing. Whereas, if you continually roll, it works better in government budget cycles, I think. So for our clients, I'm not sure how long we could go and still work for their budget cycle and their sense of what they want to budget for a cat bond. But Yeah, and in theory, it's a great idea to try to push out the maturities.
Yeah, we certainly tested out the idea of longer maturities of 4 or 5 years. I mean, and again, I think, there's certainly, I wouldn't say a consistent view on the investor side either. And when it comes to updating models or how do you handle that and potential uncertainty around it. So I think I agree. I think that's something where hopefully the market can find a little bit more of an equilibrium. Maybe before we kind of move on to other topics, maybe from a legal perspective, Colin, I think looking back at 2024, obviously, I think all parties involved, or service providers, brokers, and otherwise, obviously, have been extremely busy. Just, if you have any kind of specific comments on items worth highlighting as we look into the rearview mirror here.
Yeah, and long may it continue. But whilst my fellow panelists are all craving for predictability from a market dynamic perspective, I can say confidently that the overall legal and structural considerations of doing cat bonds are very mature now. The market participants, everybody knows what goes into these deals. Even the new sponsors that have come and contributed to the growth in the title there. The market dynamics have now got to a point, as I say, it really shows the maturity of the market, that the overall 1448 structure hasn't changed much. And that's a good thing. That, as I say, points to maturity of the market. I will say, though, that it's not without change, and some of that more recent change has been positive. And as we're sitting in London, we can talk a little bit about London in particular. But from our perspective, again, a sign of the maturity of the market is that additional jurisdictions are coming online. London in the last few years has made a play for some of the business. And we think this is complementary. So actually, in the last 12, 18 months, there have been some legal and structural changes with the London Bridge 2 program in particular that it's worth highlighting here in this jurisdiction, which, for instance, has, to our knowledge, certainly created more favorable conditions for some new sponsors to come to market, some new risks, some new perils. And that all points to Steve's title about what can we do as a market to make sure that we are constantly innovating and we are providing the growth potential, allowing certain sponsors to choose certain jurisdictions over others. That's not to say one is better than the other. It's just that choice is good for the market. So I would just say, the overall structure is very predictable. We saw that with the first bond out of London Bridge 2 for Beazley, the future property bond. That very much delivered on what investors and managers are comfortable with seeing from a legal and structural perspective, but out of a London vehicle. That was a real game changer, location of collateral, all that sort of, without getting too legal. These were kind of things that, again, showed the maturity of the market, choice of jurisdiction. So yeah, general stability, predictability, but always looking for avenues for all of us to make sure that we can keep the growth trajectory going and keep Steve behaving like Santa Claus and delivering on everyone's wishes.
Quite a lot of reliance on Artemis. Yeah. No, I think that's helpful. And and to that point, though, I think what's kind of interesting is, I think whilst we all talk about ILS being the alternative capacity, I think that is shifting to some degree. And obviously, Michael, I think the World Bank is a little bit special in that sense. But I think when we talk to our other clients, insurance companies or reinsurance companies, I think cat bonds have really become a pretty integral part of everyone's considerations for the most part. Or if you buy more than a few $100 million or even over $1 billion in reinsurance capacity, I think I would say most of our clients definitely are seriously at least evaluating a cat bond, and many of them are actually sponsoring one. So I think we also have seen this earlier this year, I think, with new sponsors coming to market and continue to use the market, which I think hopefully makes it attractive for all participants. Shifting gears a little bit in respect of, again, investors' kind of challenges, what you kind of have seen, maybe talking about investor sentiment a little bit. I don't know, Tanja, if you want to maybe start, and then what are you hearing out there from kind of what are the typical questions you get, concerns otherwise?
I would say it's quite different. It's quite a broad spectrum. Yeah. And I would distinguish between new investors. There was probably a lot of people have seen this big news media coverage end of last year that has actually had an effect. So a lot of people are drawn in by the good performance of last year, and it put us on the map. And then they're curious, and you have some that really want to learn about the space and are a little bit less opportunistic, but you have some that are only interested because the yields are double-digit now, and I think that's at least my approach is to be transparent. This is not necessarily here to stay forever, so think about whether you really want to enter the space. And as a third segment, I think you have longer-term existing investors who have had some difficult experiences in 2017. Maybe they have private exposure. Maybe they had the famous side pocket experience that has not been great. And so for them, the sentiment is much, much more challenging. I mean, they also see the benefits on the cap bond side. They also see that yields are currently great, but they also understand that it's a cycle. So it's hard to discuss with them really what their needs are and see if they want to shift something to cap bonds or whether it makes sense for them in the longer term. So it's very different conversations that we're currently seeing. It's very diverse.
Okay. I mean, Florian, from your perspective, obviously a new fund announced in January, so probably even more investor discussions, and so I'm interested to hear a little bit your experience with convincing, obviously not only investors but also kind of the newer platform considerations.
Yeah, I would say my comments are similar to what Tanja is saying. I mean, the spectrum of investors is extremely diverse, but they all have one thing in common: they want clarity on what it is they are getting, and they want to have consistently good returns, which the industry has delivered over the past couple of years. But I'm afraid what will happen if we don't. I mean, the day will come when we get a big hurricane in Miami, the funds will be down 10, 15, 20%. And there will be a lot of investors then saying, okay, well, I wasn't aware of that. How many of them will be disciplined? How many of them will top up? A lot of them are saying we will be topping up when it happens, but we all know how that works. And basically, I'm a bit worried that the industry is using the good time we have right now not to do their homework. So we sat exactly on those seats last year ago. We discussed topics of investor transparency, loss creeping, modeling of secondary perils. And here we are 1 year later with great performance. But these fundamental issues, which are still lingering somewhere in the shadows, they have not been fully addressed. And that's just literally a disaster waiting to happen, or many disasters are waiting to happen, and they will happen. And I hope that the industry can get a little bit, I would say, ahead of the curve and address these issues before they happen. Because otherwise, the success story of cat bonds can be over fairly soon.
Yeah. And in respect of investors, I mean, I think climate change obviously was a big topic. I think inflation has been a big topic. I mean, I think just if you, what are kind of the
I would say inflation, that topic is gone pretty much. Yeah. So climate change still is a big topic. Also a bit less than in the last years. The forecast for the hurricane season, those have been a big topic this year. So the hurricane season from hell, as mentioned before, it's let's see if it will become that season. But that certainly has resulted in some investors taking chips off the table. Because if you're up 30%, why risk it? And let's see how this plays out. If we truly get a quiet hurricane season, too early to tell. But if it does, I think then we will get some more questions on modeling quality. Because how can they all be united in saying this will be a horrible hurricane season and then maybe it won't be? So how is that possible? Or if it's the other way around, we will probably get a question as well, why didn't you do something about this? So in the case, when you're in cat bonds, you're always writing puts. And investors are very good in finding the weak spots, I would say. So we need to give very compelling answers.
Yeah, no, absolutely. Yeah, and then we can touch upon some of those topics maybe if we have time left. Maybe kind of another question, and Michael, maybe from your side, I think from a kind of what sponsors want from the cat bond market, and I know predictability is obviously kind of an important one. Any others kind of come to mind?
I mean, another issue for a lot of our clients and a lot of, let's say, other development institutions that are looking at this market and is the ability for the market to provide smaller payouts, sometimes very small payouts for lower severity events, is I think something that would be attractive to a lot of sovereigns from a purely political point of view. And to date, when we've had clients that want that kind of structure, we've directed them to the reinsurance market, understanding that reinsurers are maybe a bit more comfortable with somewhat regular small payouts as opposed to cat bond investors. And there's also more legal, multiple reductions in principal amount and things provide a lot more complexity in some ways. But that is something that it actually can become very politically important for governments. What I've discovered over time is that politicians don't tend to know, aren't quite knowledgeable about numbers. So it's like if you saw that movie from years ago with Dr. Evil where he was going to hold the earth hostage for $1 million, right? He said, I've had people say, well, your cat bond in this case didn't pay out, but the country got this other insurance paid out, and they paid out for $1 million. And I'll say, well, our cat bond was $250 million, and it wasn't designed for a $1 million payout. But it didn't matter. What was important was the cat bond paid out or not. And so I think that would be a structure which today I would still tell clients we really can't bring that to the cat bond market. But if you guys have a good idea for that, how to accommodate, relatively frequent, perhaps micro payments, which would allow everyone politically to say, cat bond paid. It would be a potential big enhancement to us. And that I think is something that we're really being asked about a lot more.
I mean, what's kind of interesting is I think that we certainly have seen a bigger diversity in investors too from a expected loss preference. So I mean, I think going back 5 years or a few years, I think things were certainly settling around kind of, I don't know, 1 to 2% expected loss or maybe lower. I think, that band has increased quite a lot. And I think, to your point, I think it comes down to not only the payouts, but also the risk level people want to kind of focus on. Also, I think we're certainly seeing at least some investors who have appetite for higher expected loss deals, which obviously come with higher.
And this I'm really thinking more playing with the attachment and exhaustion.
Attachment problem,
so making the attachment for small amounts low and the exhaustion extremely high, just to create that.
Can I answer?
That political profile.
I see your point, and I would say we have exactly the other way around. For us, it's very important to sit in a meeting and say, no, did not pay out, no loss, it's not affected. It's also a very binary thing. It makes a big difference whether you say this cat bond might have a 5% principal reduction, which translates likely in not very noticeable negative performance for you, or whether you can say, no, it's safe. Just in general, I think it goes into the entire frequency discussion that we heard also during the day. There is a qualitative element to it that we need to bring that message to the investor. They don't want noise. And especially with the institutional investors, the people we talk to are also not the end investors. Like, they have to sit usually in front of a committee, and it's very human when you have to do that and you have to justify why you once recommended to the committee to do this investment, that you don't want to tell them it's fine, we're still in positive territory, but we had this, and that, and it might develop and so on. So it really has this element that the binary thing that I see on your side, we also have that on that side. So I don't know if that makes it on Santa's.
Well, also I think it comes down to and again, you guys can comment better, but it also comes into comparison with other asset classes. So I think, metrics like, I don't know, how many negative months you have and stuff like that.
Well, let me try one more then. How about this? Another thing that would really help us is acceptance to wider range of modeling firms.
Mm-hmm. Yeah.
Because if we have to, every risk in the world has to be produced metrics and explanations exactly the way you like it. With the modeling firms that you are familiar with attached to it, it really limits our ability to bring new risks. So is that something we can negotiate?
Much better.
Well, and that's actually kind of maybe just to expand the question also. I think, there's things like other model regions. I think there are other, again, as we look at the market, what segments have growth potential and how can we convince insurers and reinsurers to come to the market more often? I think the other things are more aggregate type transactions, other perils. And I think, again, I think we as intermediaries, I think recognizing obviously that doesn't mean you want to have something which attaches frequently and maybe has perils which are less kind of well understood. But again, I don't think you can throw every term in one bucket. Or I think, to your point, or there could be maybe, I don't know, reserve structures where premiums are get paid out of the prime aggregate structures which are more sitting out in the tail and have high event deductibles who actually give companies the risk transfer they're looking for, but are also investors are fairly compensated. And again, I think the last question around modeling and risk quantification is obviously an important one where I think, it would be interesting to hear your views on. And so not only for countries which maybe are not well covered, but also for perils and structures which have so far have not been maybe as large in the capital market as they could be. Florian?
Yeah, well,
I might know what you're going to say.
I think in the end, my answer is very clear. It depends, what does our investor want? They want to make more money in premiums than they are losing over time. If that's the case, and if you can construct a reasonable argument that with new perils, new modeling firms, that is the case, it might work. But that being said, there's a reason why the parametric program is so successful. It's because we have data globally. Already when you look at the Philippine bonds, for example, which use modeled losses, that's already a stretch, to be honest, from acceptance perspective. And if you go one step further and you go into an entirely new topic in a new region of the world where we have hardly any data in the first place, it's probably not going to fly. I would be very surprised if people buy that. It's simply not the mandate of a cat bond manager to do that.
Yeah, maybe I also add, I totally agree with what you said, but in terms of how can we kind of do also something for the market, I think it would be a too easy position for us as managers to say, well, we use these 2 or 3 risk providers and anything else we don't look at. It's also a little bit our task to develop and to invest in these resources. And sometimes we hear, no, we don't do cyber because we don't understand it, which I think is obviously the right decision. You shouldn't do anything you don't understand, but you should work on understanding. And that's why I think we should be very open and invest, really. It takes money, obviously, but to also work with other risk providers and validate the models as soon as we can. But I understand the frustration. It's always also us, the investors, sitting here wanting new risks and wanting diversity, and then you work on bringing that, and then we say, not good enough. So it takes both sides, for sure.
Yeah. And then it's a question of pricing. Let's take a look at cyber, a peril which personally I have not invested in my fund, but at least I see the reason why people do it, because it's paying a huge novelty premium. Mm-hmm. If you were to bring a bond to the market with that novelty premium, which then again puts into a conflict potentially with your political stakeholders who you need to convince to pay for something which might happen once every 50 years, but they need to get re-elected every 4 years. So I see how that's tough. But I guess one of the sides need to move. Either we as fund managers can make a sense, okay, we do this for the better of the world. Most of our funds are ESG Article 8 rated under EU SFDR, so there could be an argument made. Or we get a higher premium, or a combination of the both. Yeah.
But I think the market is transitioning in the right direction. As the market started, it started with parametric deals because you can look it up independently and there's easy settlement. I think that really morphed into more and more indemnity deals being done and somewhat of a traditional underwriting approach or analysis being required to understand and get comfortable with these deals. I think the same is true for aggregate deals or also new perils to some degree. So yeah, I agree, Tanja. I think ultimately it is a time commitment and a resource commitment, or to basically make sure you understand it. I don't think anybody would ask investors to take risks they don't understand and are comfortable with. And I think if we reach a level of where a sufficiently large portion of the market has that understanding, I think you will also find, hopefully, a market price which everybody perceives to be fair.
It's also a regulatory question. For example, in UCITS fund, often you have a provision that the risk needs to be modeled by one of the following risk agencies. And for example, in Dublin, I remember when we launched the 12 cat bond fund at the time, this was a requirement that was given by the regulator, and it's hardwired in the documents. Now, we can agree or not agree with that, but for many funds, something like that is there. And that's also something, I guess, that the industry needs to be working on, of broadening, I would say, the scope of providers. Because whenever you have a monopoly or something which is close to monopoly, it's not healthy. Yeah. So long term, I think it needs to happen in some way or shape.
Yeah, no, absolutely. Maybe kind of touching on a kind of a different topic, secondary market importance for maybe Michael starting the sponsor side, or I think is that important? Obviously, from the investor side, very different considerations, but the secondary kind of or the secondary market, the ability to sell these bonds. Obviously, there's some kind of price information and others being generated for you to some degree, but is that a value? Is that important?
Yeah, absolutely. Secondary. I mean, we've had good experience with countries coming back to the market, and we always think, that obviously the price when we come back is going to be influenced by the price where the bonds are trading towards the ends of their life before renewal. So, we in any of the bonds we issue, cat bonds or otherwise, we like to see a robust secondary market develop.
And is that really to get price information, or just?
That's the main use of the main use. But of course, we also hear when we speak to investors, we'll hear about it in any market if our bonds are unusually illiquid. When we go to speak to an investor and say, will you be supporting us in this new transaction? If our bonds are unusually illiquid, which is thankfully I don't believe the case in this market, it would be a negative point for us. So.
Okay, so it's helpful. I mean, Tanja, maybe from your perspective.
I'm a big fan of secondary market. I used to be a trader as well, so I love that topic. I think it's super important for actually like 3 reasons. The obvious one is liquidity, especially if you have a UCITS fund. You need to provide that. Only way to really get that is secondary market. So that's the easy one. Second one is definitely information. I think it's the quickest. It's really where you see kind of turning the tides the earliest. Suddenly it dries up. There are much more buyers out there, much more sellers out there. That gives you also an indication where the primary market might be moving. So it's kind of the early indicator on pricing. And I think the third, it's rare, but sometimes there are really relative value trades to be made. So shouldn't forget that. Can be a source of return. Depends on which strategy, whether you do that systematically or not. But I think you always owe it to your investors to have a look at it and analyze it.
Yeah. And Florian,
I agree. I think it's the cat bond market's biggest benefit to have a somewhat liquid secondary market. That being said, there are a couple of things also which could improve secondary market liquidity. And like mentioned, the sharing of information is the key topic. So whenever somebody is selling a bond in the secondary market, it always makes me wonder, why are they selling it? Did I miss anything? Is there something weird in the structure? Is the bond maybe taking loss from Eden, which I didn't know about? And the cat bond market is the only market, and I've done a lot in exotic fixed income in my life, where I need to worry about this large of an information asymmetry. I think if somehow the information can be provided in a better way, in a more timely way, and if we eliminate that information asymmetry, then we get all those benefits. We get pricing discovery, we get liquidity, we can buy, we can sell. It can inform the primary market. But it just needs to be a bit more, I would say, a bit more disciplined and fair in a way.
I mean, Colin, from a kind of legal perspective, any thoughts around especially obviously sharing of information and another thing?
Yeah, I mean, it's an important aspect of why cat bonds and the highly structured nature of those vehicles have, really seen the kind of exponential growth compared to some of the broader ILS collateralized reinsurance market, of course. I mean, from the legal perspective, you do have, the obvious concerns around disclosure at the beginning, and we see that with, sort of new perils, new sponsors. and everyone on the panel's alluded to this, this is all about education and quality disclosure, not quantity, quality. And it's unusual for a lawyer to say that, but it's all about the quality, not the quantity, trust me. And that's a journey that, is both at the beginning, but also in the secondary market. There's no point in having disclosure there that is actually not any use. And so, as I say, wherever a challenge sits, there's also opportunity. And as the market matures and develops and we get better liquidity in the secondary market, better disclosure, better information flow, both before, during, and at the end, then I think that, all the mechanisms, the structure are there for that to happen. The other challenges, again, alluded to from some of the panelists in earlier sessions today are that, sponsors, particularly new ones, whether they're public, whether they're private, they do have this sort of inbuilt kind of almost Jekyll and Hyde approach to, revealing too much and then needing to have the comfort that what they would reveal, say, on the traditional side of the market is obviously in a very different format. It's often not third-party validated. There's a journey, as we're all experiencing, and we want market participants to engage on this journey to make sure that, as you were saying, between the investors and what sponsors want, there is a compromise there, and it's just about finding that compromise. The product will sell if there's someone there to buy it. That's the fundamental, and as part of that journey, something we see all the time, as I say, with new perils and new sponsors in particular, is partnering with them to go on the journey to make sure that they are giving the quality of information and disclosure in order to get to the best pricing discovery points and all that sort of stuff. So there is a method to what goes in the document. It's not for everyone. The best line for Steve tomorrow morning is that politicians don't do numbers. I mean, that's just...
Yeah, I don't quote that.
That's from heaven, but...
Maybe not the best quote.
That's on background.
but on the serious point about, why do the numbers matter? The numbers matter because you're not going to get that education and that comfort level between investor and sponsor unless the quality is there.
And it needs to be standardized. Because I think quality is one thing, but then it also needs to be standardized across cat bonds. So, for example, you have 3 cat bonds. 2 have published a loss report, and even the third one hasn't. Then I, as an investor, I need to think about, have they not published anything because it hasn't hit the threshold? So there is no loss? Or is it simply because they might have 180 days instead of 90 days reporting window? And that's making up so much time and effort to think about this. And if in doubt, I don't buy it. And there goes your liquidity.
Yeah, and I think there's really kind of a couple of considerations. One, I mean, you mentioned, Colin, public and private. I mean, I think that's, again, even whilst a lot of the cat bond information is technically very confidential, I think for public companies that is always sometimes kind of an issue. And then I think the other point, and again, I think, Colin, you mentioned that, is I think the kind of review a cat bond release number needs to undergo versus what maybe might be shared on the traditional side as some sort of a verbal estimate through a phone call is very different. And I think that might make maybe a smaller difference for a smaller Florida carrier where kind of they probably can get their head around versus kind of a nationwide kind of carrier or a large global who basically, in order to vet this number really to the point where they're comfortable releasing it, is a very different process. And I think that factors, I mean, not that that's going to help you that much, but I think that's just, a little bit a challenge we're kind of working through is really getting, on the one side, transparent information in a timely manner, but also making sure that there's no legal liability, which I think
it very much depends on the peril as well, excuse me, in the sense that, to your point, Florian, about standardization from one peril to the next, absolutely. I think some of the more novel products that come to market, cyber would be a good example, but thinking about some of the other things that we've seen recently where there's a kind of sort of whole account type deals that, more reflective of what sponsors can buy in the traditional market. Now, in theory, there's nothing legally or structurally to prevent these deals happening, but it does come down to that sort of disclosure package and what they're prepared to reveal. Because it's when you slice businesses, it's much easier to do that and then to compare and contrast. When you're looking at sort of either novel perils like cyber and people have very different risk profiles, it's all very new. And then, as I say, these kind of whole account type deals, they are much more challenging from a disclosure perspective, and they're a mile away from the standardization that you want because they're very particular to a sponsor, and they're also tend to be extremely confidential, whether the sponsor is private or public. So, that's something that, again, is, as I say, it's a great opportunity, but it's also a challenge because people have to understand that the highly structured nature of the cat bond market requires an element of, validation, good disclosure, quality disclosure of the type that you just will never going to see in a traditional market.
Yeah. And it is very different by, obviously, a parametric deal. It is much easier to provide quick, transparent loss reporting or than, an aggregate deal, for example, where maybe you're very far away from an actual attachment point and a lot of data needs to be reviewed. Yeah.
But then the question comes up, the panel's titled Prime for Records and Growth. Then I wonder, if that's the price to pay for growth to have these deals in the cat bond market, maybe as a fund manager and as an investor myself, I'd rather not grow the market as much as we did and wait for these structures to be a bit more evolved before we push it into the cat bond market. Because there is a big 60 billion private ILS market out there where the funds are not as liquid. They can much better stomach waiting longer for information than the cat bond market. So I think every risk has its right place, and I would argue that risk should not, at this stage, be placed into cat bonds.
And to be fair, that's what we saw with cyber to some extent. That was like this sort of incubator kindergarten moment for some of the cyber bonds on the private side. Exactly that.
Yeah, I think a lot comes down to educational and to bring that transparency. No, I think that's helpful. Maybe just on this kind of transparency and also I think you mentioned before, like kind of regulatory considerations. I think maybe talking a little bit about the kind of looking forward and interactions with regulators and others. I think one topic I think we briefly touched upon is the whole ESMA and consulting kind of type period. I think especially obviously the UCIT funds are large components of some of you guys' platforms. Any thoughts worth kind of sharing here, or waiting and see?
I think we're on the same page. So we will all be eager to hear what the ESMA outcome is. Yeah. I think most of us have submitted evidence to show that there is sufficient liquidity in the cat bond market, that the risk is well understood, and of course that it benefits investor portfolios. And I would hope that the regulator is coming up with a fact-based decision, even though I'm not sure, of course, I don't know the outcome yet. But that being said, should they come up with an outcome of limiting cat bonds in UCITS form, it would be a big loss for the market. So it would deprive a lot of investors of the potential to diversify their portfolios. It would, of course, be in direct contrast to what the ECB and the IOPA are pushing. And also I hear that the European Commission is also looking to cat bonds these days, what they can do. So I just hope that these people compare notes and realize that cat bonds are an asset class which makes sense for everybody. And I'm not aware of a lot of retail people invest in UCITS fund. So yes, it's UCITS, but in the end, who do we have in the fund? It's only institutional investors.
Yeah, there's not much more really to add. We definitely share that position. I think when we're always discussing about growth, as this panel is named after, one thing that could really hinder it, that we're not going where we all think we're going, is that decision. I think it would have a huge impact, not just for investors that need the UCITS format. I think there are a lot of investors in these products that don't actually need it, but they just like it and they feel kind of safe by it. And just the fact that a regulator would change that stance would give them so much to think about. It would give such a negative impression that they might redeem out of the asset class as well, even though it's not that they need the UCITS flag itself. So it's a huge thing. And you said we're all hoping, I'm basically praying. That's my center thing.
Got already 2 wishes. So I just want to make sure we leave some time for questions and also make sure people get to the bar in time. But maybe before we kind of open up for the questions, or maybe just another thing we want to talk about outlook quickly. So maybe just everybody here on the panel, 2024 kind of year-end prediction and 2030 prediction. I don't know if you guys have any ranges or others, what the cat bond market might be, to share?
It depends. I would say for this year we have two unknowns. One is obviously the result of the hurricane season, and then it's the ESMA decision, which might not even be this year. Yeah. So if both of them turn out well, I see no reason why the cat bond shouldn't be at 50 billion in some years. Yeah, and I would hope that is the case.
Yeah, I'll make it short. If always, it depends. But without the disclaimer, I'm going to be bold and say the 50 for next year, and to 2030, maybe we get the 100. Yeah, I'm optimistic.
Okay.
Yeah, I just want more capacity, so I wish you folks all great luck in your fundraising.
Colin?
My fellow panelists stole the legal response, which is it depends. And I don't do numbers, I only do words, so I wanted to.
Politician?
Yeah,
Almost
exactly.
like a politician. Well, perfect. Well, thanks for, so I think, I don't know if somebody has a microphone or so, anybody has any questions, or if this was sufficiently informative.
But no drinks then.
Exactly, that's what I think that's what Florian recommended. No drinks until their question, unless their question. So, anybody in the audience was just kind of, there's a one brave one.
Just a brief question. Sorry, John Wood at Catex. I was speaking to a few of the other guys in the audience sort of, over drinks and things. Is there a danger that we confuse? Well, we've spoken quite a lot here about risks that we don't know, the risks that we don't understand. And is there a risk that we're confusing familiarity with understanding? Insofar as we're always more comfortable with things that we recognise, do we really understand them?
Yeah, good point, I would say. Almost philosophical point. I think, that's a good point, and I think it's very, very human. That's something that we don't have experience with. We feel we don't understand, and something we have experience with, we understand. But sure, we're always talking just probabilities and not certainties. But nevertheless, models have been tested. Models have been around for certain generations, especially with the peak perils. So I think it's still fair to say that some risks are less understood than others.
Yeah. I think it was Donald Rumsfeld who had the unknown unknowns, no? And I think that's exactly the question you're asking, and these are the ones I'm afraid of. And we've had such an example just 5 years ago with COVID, when suddenly we were going through cat bond documentation to see is there any pandemic risk in them. And if something will bring the cat bond market to its knees, it's not going to be the Cat 5 in Miami, because people should expect that. It's not going to be the big earthquake in San Francisco, because that's what we get paid to take.
It might be ESMA.
It might be ESMA. That's a bit of, well, that came out of the woods, I would say. There was an unknown.
Yeah.
But it's these kind of things, and per definition, we wouldn't know about them. So, but yes, we should be afraid of them. And as soon as they become known unknowns, we should manage them accordingly.
Yeah. Any other? So I think with that, see if we can wrap up. Perfect, thank you.